Option contracts allow traders to potentially make significant returns from stock price movements compared to simply buying or selling shares of stock. However, there are certain things that you need to be familiar with before trading options, otherwise you could lose a lot of money from simply making mistakes based on misunderstandings that you have. In this video, you're going to learn how to understand options intuitively, which is going to lay a solid foundation for you as an options trader and help you make better options trading decisions. So stay tuned. Now, before explaining call options and put options to you, there are a couple key characteristics that option contracts have that shares of stock do not. The first option characteristic that you need to be familiar with is the expiration date. So all option contracts have expiration dates in which they stop trading altogether after they receive their final value. The second characteristic that all option contracts have is a strike price. Now, the strike price is the share price that the option can be converted into shares of stock should the option buyer choose to do so. Now, the third thing that you need to know is that options are quoted on a per share basis, and normal stock options are representative of 100 shares of stock. So any price that you see an option quoted at, the actual value of that option is actually 100 times that value. So for example, if an option is quoted at $3.50, that option is actually worth $350. So now that we've got that out of the way, let's cover the two option types. The first being the call option. Now, a call option's value is tied to its ability to purchase shares of stock at the call option's strike price. Now, as I mentioned earlier, a strike price is the share price that an option can be converted into shares should the option be exercised. Now, in the case of a call option, let's say we have a call option with a strike price of $100. In that case, that call option has the ability to buy shares of stock at the strike price of $100. And that ability is going to become more and more valuable as the share price increases. The value of a call option is directly tied to the call option's strike price. But why is that? As the share price increases more and more above the call's strike price, the call becomes more valuable because being able to buy shares at that strike price gets more and more valuable as the share price increases. So for example, if we have a stock that's currently at $107 and we look at the 105 call option, the 105 call option can purchase 100 shares of stock for $105 per share. And since the stock price is currently at $107, there's $2 of value in being able to buy shares $2 below the current stock price. However, if the stock price increases to $120, that 105 call option is even more valuable now because now with the stock price at $120, it has the ability to buy 100 shares of stock at $105 a share, which is now $15 below the current stock price of $120. So call options become more and more valuable as the stock price increases because you're being able to buy shares at a deeper discount to the current stock price. Let's hop over to the Tastyworks trading platform and look at some real call options that are currently trading in the marketplace to demonstrate the concepts that I've just discussed with you. Now, before getting to the Tastyworks trading platform, I just wanted to let you know that if you open and fund your first Tastyworks trading account using the project option referral code, we will give you full and lifetime access to one of our paid courses completely free. Now, while the courses are educational in nature, they do include tons of statistical analysis that is completely exclusive to these courses, and we've developed full trading plans from the analysis that we've conducted to help ourselves trade more profitably and make better trading decisions overall. So if you're interested in learning more about Tastyworks and our free course offer, go ahead and check out the link below in the description, and as I said, we will give you one of our paid courses for free if you open and fund your first Tastyworks trading account using the project option referral code. So I've just opened the Tastyworks trading platform, and right now I am on the Facebook trade page, and here we have all of the different Facebook options listed out in terms of their expiration dates from April 18th, 2019 all the way through January 15th, 2021. So what I'm going to do is I'm just going to open up the May 17, 2019 expiration cycle by clicking on the May 17 box right here. And these options have 51 days until they expire, and that is represented by this 51D here right in the middle between the calls and the puts. So there's a lot of information being displayed here, but we're going to stick to the absolute basics, and we're going to be focusing on call options, which is going to be on the left-hand side here. So in the middle, we can see that this column says strike, and these are the strike prices of every single option that we're looking at. So if we look to the left of these strike prices, we're looking at call options at that respective strike price. So for example, if we look at the 135 strike price and we go to the left, this is going to show us the information for the 135 call option. And as we can see here, the bid price and the ask price for this 135 call option is right around $32. Now, if you're unfamiliar with bid prices and ask prices, the bid price is the highest price someone is willing to pay for a stock or option, and the ask price is the lowest price that someone is willing to sell that stock or option at. So in the case of the 135 call option, this $31.85 bid price means that the highest price someone is willing to pay for this 135 Facebook call option expiring in 51 days is $31.85. And on the ask side of the equation, this $32.40 means that the lowest price someone is willing to sell this 135 call option for is $32.40. Now, the main concept I want to focus on here is that call options with lower strike prices are more valuable than call options at higher strike prices, and that's especially true when the call's strike price is below the current stock price. So right now, Facebook shares are trading at $165.87, and if we look at this 115 strike call option that expires in 51 days, we can see that the 115 call is being valued around $51.50. And that makes sense to me because this 115 strike price is just over $50 below the current Facebook share price of $165.87. Now, if we look up to the 160 call option, so the call option with a strike price of $160, this option is being valued around $12, which is significantly lower than the 115 call. And the reason for that is that this 160 call has the ability to purchase Facebook shares at $160 a share, but with Facebook at $165.87, this 160 strike price is only $5.87 less than the current stock price, whereas this 115 call has a strike price that is just over $50 below the current share price. So this 115 call is much more valuable than the 160 call because the 115 call has the ability to purchase shares of stock at $115, whereas the 160 call has the ability to purchase Facebook stock at $160 per share. So this is a very clear explanation of why call options at lower and lower strike prices are more valuable, especially when the stock price is above that strike price, because that call option has the ability to purchase shares of stock at the call's strike price, and as the stock price continues to increase, that ability to purchase shares of stock at the strike price becomes more and more valuable, as we can see reflected in these option prices. So when you buy a call option, you have to capture the stock price increase, which means the stock price has to increase after you've purchased the call option for you to make money on that trade. So with that being said, why would anybody buy a call option as opposed to buying shares of stock when in both scenarios you need the stock price to increase to make any money? Now the answer to that question is leverage. So when you buy an option, you have the potential to make a significant return on the investment that you've made in those options. For example, if you wanted to buy 100 shares of a $100 stock, 100 times 100 is equal to $10,000. So to buy 100 shares of a $100 stock, you need $10,000 or $5,000 if you're using a margin account, which is a lot of money. And if that stock price increases from $100 to $105, the profit per share will be $5, and if you own 100 shares of stock, the profit on that position would be $500. Now, a $500 profit on a $10,000 investment is a 5% return, which is quite low. Now, on that same $100 stock, let's say you buy a $5 call option, and if the share price increases significantly in the near future, the call option price increases to $10. Now, since every option controls 100 shares of stock, a call option increase from $5 to $10 actually represents a $500 gain, or 100% in the increase in the option's price. The reason people buy call options is because there's a lot of leverage involved, and it's possible to have a significant return on your investment relative to just buying shares of stock outright. So with that being said, then why would anybody buy shares of stock when you can just buy a call option that has significant return potential relative to the amount that you invested? When you buy a call option, you need the stock price to increase for your position to not lose money. It's very easy to lose 100% of what you invested when you buy call options compared to just buying stock. If you buy shares of stock, to lose 100% of what you invested, you need the stock price to go down to $0, but when you're buying call options, a very small stock price decrease can lead to your position expiring worthless, which means that there's a higher likelihood of losing everything that you invest when you buy call options compared to just buying stocks. For instance, if you buy a call option with a strike price of $100 and you pay $5 or $500 in premium for that option, and the stock price is at $95 when that option expires, well, that 100 call option is going to be worthless because at expiration, there's no value in being able to buy shares of stock at $100 when the shares of stock are currently trading for $95 in the open marketplace. So in other words, there's no need or no value for that call option, which means if you bought that call option for $5, it will expire worthless and you'll have lost 100% of what you invested. Now, if you would have bought shares of stock at $100 and the share price fell to $95, you've only lost 5% of the share value, whereas with options, you might have lost 100% of what you invested. When investing in options or buying options, there's the potential to have significant gains, such as 100% on what you've invested in those options, but compared to buying stocks, there's also a much higher likelihood that you lose 100% of what you invested in the options if the stock price moves against your position. So now that we've talked about the basics of buying call options, let's talk about the basics of buying put options, which are the other types of options that you can trade as an options trader. Now, while a call option has the ability to purchase shares of stock at the call's strike price, a put option has the ability to sell shares at the put's strike price. So while call options become more valuable when the stock price increases, put options actually become more and more valuable as the share price decreases, because with that strike price, as the share price gets lower and lower, there's more benefit in being able to sell shares of stock at the put's strike price compared to the current stock price, which is much lower. So as an example, let's say we have a $250 stock and we're looking at a put option with a strike price of $275. With the stock price at $250, there's $25 of value in being able to sell shares at $275 because the strike price of $275 is $25 higher than the current share price of $250. Now, if the stock price falls to $200, now there's much more value in that $275 put, because with the stock at $200, being able to sell shares at $275 should be worth $75 or more. So in the first scenario where we had the $275 put and the $250 stock price, that put option is worth at least $25 because being able to sell shares $25 higher than the current stock price has $25 of value. But if the stock price plummets to $200, now that $275 put is even more valuable because the ability to sell shares $75 above the current stock price is more valuable than being able to sell shares $25 above the stock price. So put options become more and more valuable as the share prices decline. So like we did before, let's hop over to the Tastyworks trading platform and look at some put options that are currently trading in the marketplace right now. Now, like we did earlier, we are going to look at Facebook options for the put option explanation. And since we've already covered the bid and ask price, we can just cut straight to the meat of this discussion, which is the fact that put options with higher strike prices are more valuable than put options with lower strike prices because, as we've just discussed, put options have the ability to sell shares of stock at the put's strike price, which means that put options with strike prices significantly above the stock price are going to be more valuable than put options with lower strike prices, and especially if the strike price is below the current share price. So right now, Facebook is at $165.87. And if we look at the 200 put option, so the put option with a strike price of $200, we can see that this option has a valuation right around $34, let's call it. And if we look at the put option with a strike price of $170, that put option has a valuation right around $10. So right off the bat, we can see that this 200 put option is significantly more valuable than the 170 put option, and that's because the 200 put option has the ability to sell shares of stock, particularly Facebook shares, at $200 a share, which is more valuable than the ability to sell Facebook shares at $170 a share, especially considering that Facebook is at $165.87. So much like buying call options, when you buy put options, you also need to capture the stock price change to profit from that options trade. So with call options, we established that to make money on a call option purchase, the stock price needs to increase for your trade to make money. Now, when buying put options, the stock price has to decrease for you to make money because you need that option to become more and more valuable after you've purchased it to later sell it at a higher price. And you're already going to know the answer to this one, but what's the benefit of buying put options as opposed to shorting shares of stock? Now, if you're unfamiliar, shorting shares of stock means you sell shares of stock that you don't own, hoping to buy them back later at a lower price. Now, when you buy a put option, your risk is completely limited to what you pay for the put option, whereas when you sell or short shares of stock, your upside loss potential is theoretically unlimited because there's no limit to how much a stock price can increase. So for example, if you buy a put option with a strike price of $100 for $5 in premium, or you pay $500 to buy that put option, the most you can lose, no matter how high the stock price goes, is $500, which is the premium that you paid for that put option. However, if you short shares of stock at $100 and the share price goes up to $200, you'll have lost $100 per share of stock. If you shorted 100 shares of stock, that would mean that you just lost $10,000 of your money, whereas if you would have purchased that $5 put option, you would have only lost $500. And just like buying call options, another benefit of buying put options is the concept of leverage. So for example, if you invest $7.50 into a put option and the stock price plummets and that put option increases to $15, you've just made $750 on a $750 investment, which means you've just made 100% return on the risk that you've taken. Alright, so you've just learned the basics of buying call options and put options, so let's go ahead and recap what you've learned up to this point. First, all options have a strike price, which is the share price that the option can be converted into shares of stock. The first type of option is called a call option, and the call option has the ability to purchase 100 shares of stock per call contract at the call's strike price. And as a result of that, call options become more and more valuable as the share price increases because the ability to buy shares of stock at the call's strike price becomes more and more valuable as the share price increases further and further above that call's strike price. Now, the other type of option is called a put option, and a put option has the ability to sell shares of stock at the put's strike price. Now, more specifically, one put contract has the ability to sell 100 shares of stock at the put's strike price. Now, as a result of that, put options become more and more valuable as they decline further and further below the put strike price because that ability becomes more and more valuable as the shares decline. So for example, if we have a put option with a strike price of $95 and the stock price is at $90, there's $5 of value in being able to sell shares at $95 when the stock price is at $90 because there's $5 of value in being able to sell shares $5 above the current stock price. Now, if the stock price plummets to $75, that same 95 put is now worth at least $20 because there's $20 of value in being able to sell shares $20 above the current stock price. So in short, when traders buy call options, they want the stock price to increase as much as possible in as short a time period as possible. Now, when traders buy put options, they want the stock price to decrease as much as possible in as short a time period as possible because that will result in the greatest profits for the put buyer. So up to this point, we've talked about buying put options and buying call options, but there's a counterparty to every single trade. And that means that if someone buys an option, another person has to sell that option at the exact same price for that transaction to take place. So let's switch gears and talk about selling options. First, we'll talk about selling call options, and then we'll talk about selling put options. So as I mentioned earlier, a call option does not really have any real value when the call's strike price is above the stock price because there's no value in being able to buy shares above the stock price. So if you can buy shares of stock at $100 right now without any options, there's no real value in buying a 105 call and purchasing 100 shares of stock at $105 a share because you can just buy shares of stock for $100 in the open marketplace without using the option. Now, with that said, it's possible to make an options trade that profits when the stock price remains below a certain price as time passes. And one way to do that is by selling call options. So as I discussed earlier, call options increase in value as the stock price increases, but on the other hand, they actually lose value as the stock price decreases or as time passes while the stock is below the call's strike price. So one trade that traders make sometimes is called selling a call option or shorting a call option, which means they sell the call option without owning it first. Now, the way that trade makes money is if the stock price remains below the call's strike price as time passes, and the best case scenario is that the stock price is below the call's strike price at expiration, because we know in that scenario the call option will expire worthless. So as an example, if we have a $100 stock and a trader sells the 110 call for $2.50, if that stock price remains below the 110 call's strike price of $110, that option will steadily lose value over time because there's less and less probability that the stock price will increase, therefore resulting in the 110 call becoming valuable at some point. Now at expiration, if the stock price is below the call's strike price of $110, that option will be worthless because, as we discussed earlier, there's no value in being able to buy shares above the current stock price, and at expiration, an option with no real value will be worthless. Now, if the stock price does increase significantly, there's immense loss potential. So let's go ahead and hop over to the Tastyworks trading platform, and I'll show you exactly what I mean by that. Alright, so as I've mentioned, selling a call option is a strategy that can be used when you want to profit from a stock price not exceeding a certain price in the future. But on the other hand of things, if the stock price does increase significantly, selling a call option all by itself, which is referred to as selling a naked call option, is an extremely risky strategy, and I'm going to demonstrate that right now by looking at a Facebook short call trade. So right now Facebook just closed at $165.05, and the trade I'm going to queue up is selling the 170 call that expires in 51 days. And to do that, I'm going to click on the bid price of $6, and actually it queues it up for me at a mid price of $6.05, which is just the halfway point between the bid and ask price. So let's say I wanted to sell this 170 call option for $6.05. As we know, that means I'm actually collecting $605. And as we can see here, it says my maximum profit potential on this trade, if I were to make it, would be $605. And it also says my maximum loss potential is negative infinity. And that's because there's no limit to how much a stock's price can increase. And with that being said, there is no limit to how much this 170 call option could be worth in the future. So we are unable to quantify a maximum loss potential for this position because we can't do so without knowing the stock's upper limit. And since there is not an upper limit, we cannot quantify the maximum loss potential. So I'm going to go to the curve view. Analysis is already activated, and I'm just going to visualize the risk profile of this position. As we can see here, this little red flag is right over the 165 price level, and that's telling me that Facebook is currently trading right around $165. Now, as we can see here, at every point to the left or below this 170 call's strike price, we see that the maximum profit potential of $605 would be realized if Facebook were to be below the 170 price level at expiration in 51 days. Now, as we can see here, this looks like a very favorable strategy because with Facebook at $165, it's already right at the maximum profit point, because if Facebook is still at $165 in 51 days, this 170 call will be worthless because there's no value in purchasing shares with the call option at $170 when we can just buy shares at $165, just buying shares outright and not using any options. So the best case scenario is that Facebook stays below the 170 call's strike price, and at expiration, if Facebook is below $170, this call option will expire worthless, and if I sold it for $6.05 or $605 in premium, that would mean my profit on the trade would be $605. Now, on the other hand, if Facebook were to increase significantly, we can see that we can get into quite a bit of trouble. So let's say some news came out and Facebook went from $165 up to $200 before this option expired. If that were to happen, it's telling me that my estimated P&L at expiration is a loss of $2,395. And that's because at expiration, if Facebook were to be at $200, this 170 call option would be worth $30, which is $3,000 in premium. But since I collected $605 when I sold it, my P&L would be a loss of $2,395, which is that $3,000 value at expiration less the premium that I received, which is $605. So that's just if the stock price went to 200, but as we can see here, if I keep going to the right, the loss gets progressively larger because as the stock price increases, that 170 call option will increase with that stock price. And since there's no limit to how much a stock price can increase, selling a call option all by itself or selling a naked call option has unlimited loss potential in theory. So I've just shown you one example of how selling an option can be used to profit when a stock price does not exceed a certain price level as time passes. Now, I will say that selling a call option by itself, which is referred to as selling a naked call option, is an extremely risky strategy because, like shorting shares of stock, there is no upside potential or upside limit for a stock price. So if a stock is currently at $100, there's nothing stopping that stock from going to $1,000 at some point in the future. So now that we've talked about selling call options, let's flip over to the other side of the equation and talk about selling put options. Now, as we've discussed, a put option's value stems from its ability to sell shares of stock at the put's strike price compared to selling shares of stock at the current market price. Now, with that being said, it's possible to profit on options trades by selling a put option, in which case you'll make money if the stock price does not drop below the put's strike price over time, and ultimately you'll keep 100% of the profits if the stock price is above the put strike price at the time of expiration. So let's hop over to the Tastyworks trading platform yet again so I can show you how selling a put option works and the risk and reward associated with that particular option trade. So to keep things consistent, I'm going to stay with Facebook options. And first, let's go ahead and look at the chart of Facebook by clicking on this chart button right here. Now, as we can see here, in recent months, Facebook has rebounded from the $160 price level numerous times. And if you're a trader who believes in technical analysis, support and resistance levels and whatnot, maybe one trade you would look at would be to sell a put option with a strike price at $160 or maybe slightly below it if you wanted to give yourself some room. But let's go ahead and looking at selling the 160 put option. So if I go back to the trade page and I have the 51-day options opened up, if we go to the 160 strike price and look at the put option, we can see that the 160 put option expiring in 51 days is currently being valued at $5.50, let's call it. So if I wanted to sell this put option, I would just click on the bid price because that is the highest price someone is willing to pay for that option. And me being a seller, I want to sell this option for as much as possible, which means I am going to click on the bid price. Now, when I do that, it queues up this position right here and it entered a price for me of $5.47, which is the midway point between the $5.40 bid price and the $5.55 ask price. So let's go ahead and actually visualize the risk and reward potential of this trade by clicking on the curve tab and then activating analysis. So when I do that, this brings up a visualization of the profit and loss potential of this particular trade. Now, if I'm selling the 160 put option, remember that in 51 days at the time of this put's expiration date, if Facebook is above the strike price of $160, this put option will be worthless because there's no value in using this put option to sell shares of stock at $160 if Facebook is at a price higher than $160 like it is now. And that's because I can just sell shares of stock right this second for $165. I don't need the 160 put to help me with that. So one way you can profit by selling put options is that if you believe a stock price will stay above a certain price through the future or through some specific date, in this case being May 17th, 2019, you can profit by selling a put option, and if the stock price remains above that put strike price over time and through expiration, you will keep 100% of what you sold that option for. So for example, if I sell this option for $5.47, in actual dollar terms, this option is worth $547. And if we look here, it says my maximum profit is $547, which stems from the fact that if I sell this put option for $547 and it expires worthless or with a value of $0 at expiration, then I will keep 100% of what I sold the option for. So if I sell this 160 put, the best case scenario is that Facebook is above $160 at expiration, in which case this put option will expire worthless and I will keep 100% of what I collected for selling this option. However, as we know, put options get more and more valuable as the share price decreases. So if Facebook were to fall to, let's just say, $140 at the time of this option's expiration in 51 days, then the loss on this position is estimated to be about $1,500 just for selling one put option. And that's because at 140, this put option is going to be worth $20 because it has a strike price that's $20 above the stock price if Facebook were to be at 140. And since I sold it for $5.40 or $5.50, an increase in the option's value to $20 would represent a loss of about $1,500. Now, while selling put options using a lot of leverage and a lot of contracts can be immensely risky, when you compare selling one put option to purchasing 100 shares of stock, selling a put option compared to buying 100 shares of stock is less risky in 100% of cases because you collect a premium for selling that put option, whereas if you just purchase 100 shares of stock, you don't collect any premium and you don't have any downside protection. So when comparing 100 shares of stock to selling one put option is always going to be less risky than purchasing 100 shares of stock, which is one practical application of using options in addition to your long stock portfolio or your long-term investments. So let's hop over to the Tastyworks platform and I'll compare those two strategies side by side to demonstrate exactly what I mean. So as I've mentioned, when selling a put option, your risk is going to be less than if you purchased 100 shares of stock at that put strike price in 100% of scenarios. So let me go ahead and prove that to you. So first I'm going to look at the loss potential, and let's just say I buy 100 shares of Facebook stock at $165 per share. As we can see here, it says my maximum loss potential is $16,500, which stems from the fact that if I purchase 100 shares of Facebook stock at $165 a share, I am purchasing $16,500 worth of stock, and if Facebook goes out of business and the share price goes to $0, my loss is going to be 100% of what I invested, which is $16,500. Now, let's go ahead and look at what my maximum loss potential will be if I sold the 165 put. So if I sell the 165 put, I'm collecting $7.55 or $755, and that means my maximum loss potential is $15,745, which stems from the fact that if Facebook shares go to $0, this put option with a strike price of $165 will be worth $165, since if the stock price goes to $0, this strike price is $165 above the stock price of $0, in which case the put option has $165 of value because it can sell shares of stock $165 above Facebook's stock price if it were to go to $0. Now, since I've collected premium for selling this put option, I've collected, let's just say, $750. That means that my loss potential is actually $750 less than if I were to just purchase 100 shares of stock at the strike price of $165, as opposed to selling the 165 put. So at this point in the video, we've covered the 4 most basic options trades that anyone can make in their portfolio and will make as an options trader. Those trades are buying a call option, selling a call option, buying a put option, and selling a put option. When you combine those trades, you can create more complex option positions such as vertical spreads or iron condors or short straddles, all of which are completely separate option strategies that you'll become familiar with in the future. So let's recap those basic options trades that we've just discussed in this video. The first basic options trade is buying a call option, And as we've discussed in this video, call options increase in value as the share price increases further and further above the call's strike price. When a trader buys a call option, they want the stock price to increase as much as possible in a short time period, as that will result in the most significant profits for that trader. Now, on the other side of that trade is selling a call option. So when a trader sells a call option all by itself, that trader wants the stock price to remain below the call's strike price as time passes, and ultimately they want the stock price to be below the call's strike price when that option expires, as that will result in that short call trader keeping 100% of the premium that they collected when selling that call option. Now, the other option type that we've discussed in this video is the put option. Now, when a trader buys a put option all by itself, that trader wants the stock price to decrease as much as possible in a short time period, because we know that put options increase in value as the share price decreases further and further below that put strike price, because that put's ability to sell shares of stock at the put strike price becomes more and more valuable as the share price declines further and further below that put's strike price. So when a trader buys a put option, they want the stock price to decrease as much as possible and as fast as possible, as that will result in the most significant profits for that trader. Now, on the other side of the equation, a put seller wants the exact opposite. When someone sells a put option all by itself, they want the stock price to remain above the put's strike price as time passes, and ultimately they want the stock price to be above the put strike price when that put option expires. If the stock price is above the put strike price when the put option expires, that put option will be worth nothing, and that put trader that sold the put option will keep 100% of the option's price that they collected when they initially sold that option. So now that we've covered the most basic transactions that options traders will make, now we need to talk about another critical concept that you need to understand as a beginner options trader, which is the concept of intrinsic value and extrinsic value. All option prices have two price components, one being intrinsic value, or the real value of that option's ability to buy or sell shares of stock at the strike price as opposed to the current share price, and the second price component is extrinsic value, which is any value the option has that exceeds its intrinsic value. Now we're going to talk about each of these concepts in depth. So let's start with intrinsic value. Intrinsic value can be interpreted as an option's real value, or the value of that option's ability to buy or sell shares of stock at its strike price as opposed to buying shares of stock at the current share price. So for instance, if we have a stock that is at $140 and we look at the call option with a strike price of $130, that 130 call has $10 of intrinsic or real value, because there's $10 of value in the ability to buy shares of stock at $130 when the stock price is currently $10 higher at $140. Now, if that same stock increased to $155, that same call option with a strike price of $130 now has $25 of intrinsic value, because there's $25 of value in being able to buy shares of stock at $130 when the stock is currently $25 higher at $155. So in other words, a call option's intrinsic value is equal to the current stock price minus the call's strike price. So if the current stock price is $180 and the call's strike price is $165, 180 minus 165 is $15. Now, it's important to note that options do not have negative intrinsic value, as they either have zero intrinsic value or they have positive intrinsic value, and an option's value is never negatively intrinsic. So if you calculate that the option does not have intrinsic value, but the option is still worth something, then 100% of that option's price is extrinsic. So extrinsic value is the portion of the option's price that exceeds the intrinsic value that it has. So for example, if we have a call option that has $12 of intrinsic value, but the call option's overall price is $17, then that additional $5 over the intrinsic value is the option's extrinsic value. Now, what is extrinsic value? Well, extrinsic value can be thought of as the option's potential to become more valuable before it expires. For instance, if you look at an option with 60 days before it expires and that option has no intrinsic value, it doesn't necessarily mean that the option is worthless, because there's still 60 days left for the stock price to move up or down, which could cause the option to become more valuable and eventually become intrinsically valuable, which means for call options, the stock price increases above the strike price, and for put options, the stock price falls below the strike price. So just because an option doesn't have any real or intrinsic value right now, it doesn't mean that the option is completely worthless, because as we've discussed earlier, all options have expiration dates, and if an option has 60 days until expiration, just because it doesn't have any real or intrinsic value right now, there's still 60 days left for that option to potentially become intrinsically valuable and therefore more valuable overall. So extrinsic value can be thought of as the potential for that option to become more valuable in the future. Now, at the time of an option's expiration date, the option will have no more extrinsic value remaining because that option's final value is now known. So when the unknowns become known, there is no more extrinsic value in the option because we know its final value because it just reached expiration, and we can take the difference between the stock price and the strike price to determine that option's value. So in other words, at expiration, options will only consist of intrinsic value or their real value, and they will have no more extrinsic value remaining because the uncertainty around what they will be worth is now known because they've just expired. Now, extrinsic value is such an important concept to understand because it is the foundation of what options trading is all about. And more importantly, as time passes and as an option approaches its expiration date, the extrinsic value that remains in that option will seemingly wither away, which is sometimes referred to as time decay or extrinsic value decay. Now, in the context of actually trading options, extrinsic value is great for those who sell options because traders who primarily sell options as a strategy want their option prices to decrease. Now, since extrinsic value comes out of option prices as time passes, extrinsic value decay or time decay works in the favor of traders who sell options. So if I sell an option for $5 and it's currently out of the money, meaning it has no intrinsic value, as time passes, that $5 option will approach $0, and the decrease in that option price is going to generate profits for me as an option seller, because as an option seller, my goal is to sell options at a price that is higher than what I pay for it to close it later. Now, while extrinsic value decay benefits option sellers, extrinsic value decay or time decay actually works against option buyers, which is why option buying can be a very, very risky trade, and in theory, it is a low probability trade, meaning that if you buy an option, in theory, you have a less than 50% probability of making money on that position. Now, that's one of the reasons selling options is so popular as an option strategy, because as you sell an option, time is working in your favor. So if you sell options, each day that passes without a change in the stock price is going to result in small decreases in that option price through extrinsic value decay, which is going to generate profits for you as an option seller. So as an option seller, it's possible to make money without doing anything and just letting time pass, which is why theoretically selling options is a high probability trading approach, which means that when you sell options, in theory, you have a higher than 50% probability of making money on that trade. Now, I'm going to leave a link in the description below to a video on intrinsic and extrinsic value. Since I feel it's such an important concept, I want you to watch a specific video just on that topic so you can further learn about intrinsic value and extrinsic value as it relates to options. Up next, we're going to talk about exercise and assignment, which are two critical options trading concepts that you need to understand as an options trading beginner. Now, another critically important piece to options trading is the understanding of the fact that options can be exercised by the option buyer. Now, what that means is if someone buys an option and they exercise the option, that means that they are making the decision to convert the option contract into shares of stock at the option's strike price, as we've discussed earlier. So for example, if we have a call option with a strike price of $110, that means that if the option buyer exercises that 110 call option, they are saying that they want to purchase 100 shares of stock per call option for $110 per share. So as I just mentioned, if a call buyer exercises the call option, they are making the decision to buy 100 shares of stock per call option at the call option's strike price. So exercising a call means you are buying shares of stock at the call's strike price. Now, on the other hand, if a put buyer exercises their put option, they are making the decision to take their put option and convert it into short shares of stock or sell shares of stock at the put's strike price. So for instance, if a trader buys a 95 put option and they later exercise that option with a 95 strike price, they are saying that they want to sell 100 shares of stock per put option for $95 a share, which is the put's strike price. So when a trader exercises a put, they are making the decision to sell 100 shares of stock per put contract at the put's strike price. Now, with that being said, it's important to note that option buyers rarely exercise their options, because when an option is exercised, the trader who exercised the option essentially burns the extrinsic value that is remaining in that option. So for instance, if I have a call option that has $2 of extrinsic value in it, or $200 of that option's price is extrinsic, if I make the decision to exercise that call option, I'm effectively giving up that $2 of extrinsic value, which means that if I exercise that option, I'm essentially flushing $200 down the toilet just by exercising that option. The only time an option is really exercised is when the option has very little extrinsic value, meaning as close to $0 as extrinsic value as possible. So if an option has lots of intrinsic value and very, very little extrinsic value, that's a more likely scenario to see the option get exercised compared to a scenario where the option has $3 or $4 of extrinsic value remaining, in which case, if the trader did exercise that option, they would effectively be flushing $300 to $400 straight down the toilet. Now, as we've discussed earlier, there's a counterparty to every single trade, and for every option buyer, there is an option seller. So what happens to the option seller when the option buyer exercises the option? The answer is that when somebody exercises their option, somebody who is short that option or sold that same option that was exercised is chosen at random and is assigned the opposing share position as the person who exercised the option. Now, I know that's confusing, so let me give you a concrete example to demonstrate exactly what I'm talking about. Let's say we have a call option that has a strike price of $125. If the option buyer exercises that 125 call, they're going to purchase 100 shares of stock per call option that they exercised for $125 per share. Now, since that option exerciser buys 100 shares of stock per contract at $125 a share, that means somebody who was short the 125 call or sold that 125 call as an opening trade, they will end up with a share position of negative 100 shares, or they will short 100 shares of stock per 125 call that they were assigned on. So if a 125 call buyer exercises the option, they're going to buy 100 shares of stock per call contract at $125 a share. But unfortunately, some trader that was short that option is selected at random. They will be assigned 100 shares of short stock at $125 a share when that option is exercised. In short, when someone exercises an option, somebody who is short that option is chosen at random and will get assigned the opposing share position as the person that exercised the option. So in the case of a put option being exercised, somebody is selling 100 shares of stock at the put strike price when they exercise the put option. And that means that someone who is short that put option or sold that put option as an opening trade will get selected at random, and they will actually purchase 100 shares of stock at the put strike price if they are assigned on that short put option. Now, being assigned just means somebody who owned the option exercised the option, and being assigned means you are assigned the opposing stock position that the exercising party just took on. So here's a diagram that shows all of the potential scenarios for option buyers and sellers when an option is exercised. Now, being assigned on a short option position is perhaps the greatest fear of all beginner options traders, because you cannot control when you are assigned on that short option. Now, as I mentioned earlier, options are rarely exercised because the person who exercises the option is forfeiting or essentially burning all of the extrinsic value that exists in the option, and because of that, options are rarely exercised. And since options are rarely exercised, it is quite rare to get assigned on a short option. I've personally been trading options for over 6 years now, and I've been assigned on a short option maybe 2 or 3 times over that entire period. So with that being said, you should not fear getting assigned on a short option. And if you do get assigned on a short option, that does not automatically increase your risk substantially, because because in most cases, the risk of your position after you get assigned a short stock position is actually going to be the same as when you actually had that option position on. So if you are assigned on a short option position, do not worry. Your risk has not increased substantially, and at the end of the day, you can just close that stock position that you got assigned and you can get rid of it and therefore take all of your risk off the table if you are uncomfortable. So to finish things up, we need to cover one more critical concept, which is that all options have expiration dates. So what happens to an option when it reaches its expiration date? So first we'll start with the easiest outcome, which is that if an option does not have any intrinsic or real value at expiration, that option will expire worthless, meaning that it will expire with a value of $0 because, as we discussed earlier, at expiration an option will only consist of intrinsic value, and if the option does not have any intrinsic value at the time of expiration, it expires worthless and will just disappear from the trader's account who had that option. So to recap, what that essentially means is that any call option with a strike price above the current stock price at expiration will not have any intrinsic value because there's no value in using that call option to buy shares of stock at the strike price when the strike price is above the current stock price. So at expiration, any call options with a strike price above the stock price will expire worthless, and they will just disappear from all the traders' accounts that have those call options. Now on the put side of the equation, put options have no intrinsic value when their strike prices are below the current stock price because there's no value in using the put option to sell shares of stock below the current stock price or at the put's strike price. So for instance, if the stock price is at $100 and a put option has a strike price of $90, that 90 strike put option will have no intrinsic value, and at expiration, if the stock is at $100, that put option with a strike price of $90 will expire worthless and it will just disappear from the accounts of the traders who have that option. Now on the other hand, if an option does have intrinsic value at expiration, meaning that for call options the strike price is below the stock price and for put options the strike price is above the stock price, now those options that do have intrinsic value at expiration will be automatically exercised, meaning they will be automatically converted to the corresponding stock position based on the option position in that trader's portfolio. So for example, anybody who owns a call option that is in the money or has intrinsic value at expiration, if they hold that option through expiration, they will end up with 100 shares of long stock per call option that expired in their portfolio. So for example, if a trader had 5 call options that expired with intrinsic value, that trader will end up with 500 shares of long stock on the following trading day because that call option that had intrinsic value at expiration was automatically exercised, leaving that trader with 500 shares of long stock since they had 5 call options that they allowed to expire in the money. Now really quickly, if a trader has a short call option that is in the money at expiration, that trader will end up with 100 shares of short stock or negative 100 shares per call option that they allowed to expire in the money or with intrinsic value. On the put side of things, if a trader owns a put option that they allow to expire when it has intrinsic value, that put option will be automatically exercised into negative 100 shares of stock or short 100 shares of stock per put contract. So if a put trader owns 3 put contracts and that put contract has intrinsic value at the time of expiration, that trader will end up with 300 shares of short stock or negative 300 shares at the put strike price at expiration. And lastly, if a trader has short put options that have intrinsic value and they hold those short put options through expiration, that means that the trader will end up with 100 shares of long stock per put contract that they allowed to expire in the money or with intrinsic value. So for example, if a trader has 7 put contracts that they sold, and those 7 put contracts have intrinsic value through expiration, and the trader holds those put options through expiration, they will end up with 700 shares of long stock at expiration because they allowed 7 short put contracts, meaning they sold 7 put contracts and they allowed them to expire with intrinsic value. That means that those put options are automatically going to be exercised, and since that trader sold those put options, they will actually own 100 shares of stock per put option if they hold those short puts through expiration and those short puts puts have intrinsic value when they expire. Now, one exception to this automatic exercise clause that I've just discussed is that if you're trading cash settled options, such as VIX options or SPX options, those options do not ever convert to shares of stock because those products don't have shares of stock. In which case, those options just settle to their cash value or their intrinsic value at the time of expiration and will never be converted to shares of stock. Alright, so we've covered a ton of content in this video, and it's perfectly normal if your head hurts. I know I was there when I was first learning about options. Every time I would watch a video, I'd have no idea what was going on. My brain would start to hurt and I'd want to give up, but I'm telling you, if you continue with it, it's going to get significantly easier as you get more exposure to options. So with that being said, I want to quickly recap all of the main points that I discussed in this video so you can have clean takeaways from all of the key sections that we've just discussed. First, there are two types of options. First is a call option, and the second is a put option. Call options become more valuable as the stock price increases because call options have the ability to purchase shares of stock at the strike price, and that ability to purchase shares of stock at the call's strike price becomes more and more valuable as the stock price increases further and further above the call's strike price. Now, on the other hand, call options decrease in value when the share price falls because that ability to buy shares at the call's strike price becomes less and less valuable as the share price decreases. And as a result of that, traders who buy call options as a trading strategy want the stock price to increase as much as possible in a short time period because that will result in significant gains for that call option buyer. On the other hand, people who sell call options as a trading strategy want the stock price to decrease as much as possible, or at least remain below the call's strike price as time passes, as we know that will result in extrinsic value decay, which is going to generate profits for the call option seller. Now, the other type of option, a put option, becomes more and more valuable as the share price decreases because a put option has the ability to sell shares of stock at the put's strike price, and that ability to sell shares of stock at the put's strike price becomes more and more valuable as the share price decreases further and further below the put's strike price. Now, as a result of that, traders who buy put options want the stock price to decrease as much as possible in a short period of time because that will result in significant gains for the trader who buys the put option. Now, on the other hand, traders who sell put options as a strategy want the stock price to increase or at least remain above the put strike price as time passes, because we know that if the stock price remains above the put strike price as time passes, that put option's value is going to decrease because it is all extrinsic, and as time passes, extrinsic value decreases out of option prices until it reaches $0 at the time of expiration. Next, all options have prices, and all option prices consist of two components, the first being intrinsic value and the second being extrinsic value. Intrinsic value is the ability to buy or sell shares of stock at the option strike price instead of the current share price that is being traded in the marketplace. Call options have intrinsic value when the stock price is above the call's strike price because there's value in being able to purchase shares at the call's strike price when the stock current price is higher than the call's strike price. Now, on the other hand, put options have intrinsic value when the stock price is below the put strike price because there's value in being able to sell shares of stock at the put's strike price when the stock price is below or at a discount to that put's strike price. An option's extrinsic value is the portion of the option's price that exceeds any intrinsic value that it has, and extrinsic value can be interpreted as the option's potential to become more valuable before it expires. So just because an option is worth $5 and has $0 of intrinsic value, it doesn't mean that the option is worthless because let's say it has 60 days until expiration. That means there's 60 days left for the stock price to move up or down, in which case that option could become more and more valuable and hopefully take on intrinsic value before it expires. Extrinsic value is sometimes referred to as time value because options with more time until expiration have more extrinsic value, which just just means that with more time until expiration, there's more time for the stock price to move around, which means there's more time for that option to become intrinsically valuable and significantly more valuable than it is right now. Now that means that options with less time to expiration have less extrinsic value, which means that the option has less time to become more valuable since it expires very, very soon. On the other hand, options with lots of time until expiration have lots of extrinsic value because there is lots of time left for that option to become more valuable as the stock price changes. Now, at the time of an option's expiration date, the option's value will be 100% intrinsic as all of the extrinsic value withers away as time passes and as that option approaches its expiration date. Now, for that reason, the passage of time and the decrease in extrinsic value is sometimes referred to as time decay or extrinsic value decay. Now, if an option doesn't have any intrinsic value at the time of its expiration date, that option will expire worthless and it will simply disappear from the account of the trader who has that option. In regards to exercise and assignment, call options and put options can be exercised, which means the person who bought that call or put option is making the decision to buy or sell shares of stock at the option strike price, thereby converting the option into shares of stock. When a call option is exercised, the option buyer is purchasing 100 shares of stock at the call option strike price, and when a put option is exercised, the put buyer is selling 100 shares of stock at the put option strike price. In both cases, when an option is exercised, the option buyer is converting the option into long or short shares at the option strike price. Now, since there's a counterparty to every single trade, when somebody exercises their option, a person who is short that same option contract is assigned the opposing share position as the trader who exercised the option. So for example, if a trader buys an option and later exercises it, they are purchasing 100 shares of stock per call contract at the call's strike price, which means somebody who is short that call option will be assigned 100 shares of short stock at that same strike price. Now, as I mentioned earlier, fortunately for us option sellers, options are rarely exercised because the option buyer essentially burns any extrinsic value that exists in that option, which means in most cases it does not make any logical sense for the option buyer to exercise the option, and if they're not exercising the option, that means we're pretty safe as option sellers. Lastly, when options reach their expiration date, any options that don't have any intrinsic value will simply expire worthless and disappear from the accounts of the traders who had positions in those options. Now, the options that do have intrinsic value at expiration are automatically exercised, which means any traders who have positions in those options will end up with the corresponding share positions that we discussed earlier if they hold those in the money options or they have options that have intrinsic value and they hold those options through expiration. That's going to do it for this video on call options and put options, everybody. My name is Chris Butler from projectoption.com, and I really hope you enjoyed this video. Feel free to check out some more of our options trading videos that you're going to see popping up in just a second, and be sure to subscribe to this channel so you can get all of our options trading videos in the future. Once again, I'm Chris from Project Option, and thank you for watching this video.